So before we go on to trade plans, I would like to recap that when we set up our trade, the reason why we are setting up trading goals is so that we have a very clear objective, and this clear objective will guide us through the next part, which is our trade plans, how we intend to buy and sell and make money in the broader situation. Okay, so setting up trade plans, like I said, we are trying to ensure that we are profitable overall. So we need a master plan, how to make sure that all our trades, even though we win some and we lose some, or make some money and we lose some money, that overall it is profitable, right? So if you realize just now when we were talking about risk and return objective, you are risking $200 to make $500. So if you are risking $500 to make $200, that doesn't really make sense, right? So so I'll elaborate more when we come to the plans. Okay, so for the plans, I break it up in two groups. One is the master plan, and the other one is the trading plan. The trading plan is for individual trades, while the master plan is a overall picture. Okay, so master plan, like I mentioned, it ensures that our overall trading is profitable. So you might not make money all the time, right? Maybe let's say for every 10 trades, right? Every 10 trades, if you make the same amount of money on each or on each of the profitable trades and lose the same amount of money on each of the non-profitable trades, but you have 6 out of 10 profitable trades and only 4 non-profitable trades, then your overall trading plan trading will be positive. You get me? So for example, I make 10 trades. For six trades I make $100 each, and for the 4 trades that I lose $100 each. So my total out of 10 trades, I am up by $200. That's what it means. So this is the kind of concept that we need to have when we are thinking of a master plan, because we can't possibly be profitable 10 out of 10 times for every trade, right? So when we talk about the master plan, we also need to think about the extent of the profits, be very disciplined about that, and the limits to the losses, also be very disciplined about that. Like I mentioned in the example of 10 trades, you make $100, you lose $100. That's quite equal, right? So imagine this situation where you keep to I'm risking $200 for $500, and you have a same situation of 10 trades, and every time I make money, I make $500. So if I make money 6 times, I make $3,000, right? And every time I lose money, I lose $200. So if I lose 4 times, I lose $800, right? So your total 10 trades, if you keep to that kind of discipline, where I'm risking $200 for $500, then out of your 10 trades where you make 6 and lose 4, you will be profitable, you'll be positive by $2,200. Everybody get that? Okay. So like I was mentioning, so that's the extent of our profits we need to think about, limits to our losses, as well as overall exposure and cash flow, which is like every 10 trades. Okay. So like I said, if we are the extent of our profits, with the previous example, we can say that I'm risking 200 to make $500, but sometimes as humans, we get a bit greedy. So we say that, hey, maybe I can make more than $500. But of course, we have to tell yourself that we have to take profit at a certain time. And maybe you can tell yourself that you are always going to take profit if you are making more than $1,000 on a trade at any one point in time. Something like that. Okay. So limits to losses is not only by the monetary value, let's say $200 for every trade, but you can say that I will not lose more than maybe 2 ticks for every trade. So 1 tick may be 1 cent, and you might have 1,000 shares, and that is 2 ticks will be $20. So it depends on how you want to manage it, whether in terms of monetary value or in terms of number ticks. And overall cash flow and overall exposure, just now we were talking about 10 trades. 10 trades might be a bit too much. Some people will say that, hey, I do not want to have more than 3 open trades, open positions. I do not want to trade 3 different stocks at the same time. Okay, so that's a method of managing our overall exposure. And what we mean by never roll over positions is that there's a saying that of people falling in love with a stock or something, or a counter, right? So we never roll over positions means that when we sell something, we never go and buy it back straight away. Okay. So next, we go on to the specific trading plan. So just now we are talking about the master plan to make sure that overall our trading is profitable. Now we go on to the individual trade plan. So for individual trades, what are we looking out for? How do we plan for individual trades? Okay. So the individual trade plan ensures that each trade is profitable. So of course, going back to the previous example where I'm risking $200 to make $500, the potential profit must be more than the potential loss, right? Then it makes sense, right? Over the years, I have clients coming over to me and asking me, hey, I think I can make a bit from trading this stock. And I'm asking, and then I'll ask back, what if it doesn't go up like you think it would? And then he say, oh, so I'll lose. And I'll say, so how much can you afford to lose? They say, oh, I can afford to lose $500. So if it goes up, how much do you make? Oh, I make $200. Then does that make sense? You are risking $500 downside for a $200 upside, right? So for each trade, you must always think in this perspective that you are always the potential gain that you get must definitely outshine the potential loss. Okay, so with this, there are 2 things that we need to consider that I'll zoom in to each of them later. That is the entry price, when to buy, when to sell first. The exit price, when to sell to get out, or when to buy back, you are selling first. So for short-term trading, there is buy first, sell later, or sell first, buy later. Okay, and so entry price means the first action, exit price means the second action. Next thing is the sizing. So we need to think of having a proper trade size. We cannot say that we like this one more, so we buy more of these. Or we like this stock more, so we buy more quantity in this trade. Not really like that. When we talk about sizing, means that every trade we do, we have a certain size. Some people will consider the size in terms of monetary value or in terms of quantity. Okay, we'll talk more on the individual right now. So like I said, entry and exit price, right? When we talk about when to buy and when to sell, a lot of people will use what we call technical analysis to read charts, right? So since today we are talking about the basics of trading, we won't go too deep into this technical analysis. There are many other courses and many other live webinars available on SGX Academy to introduce this topic to you more in depth. But now for an example of technical analysis, the most common thing people use is price and volume action. So some of you might be wondering, why do some older traders or more seasoned traders look at top volume every day, right? They are looking for the stocks with the highest volume, because price volume action means something, right? So some people, when they see price go higher with increased volume, that means that there is a lot of participation, so they will come in to participate as well, right? For the short term, for trading purposes, right? So next thing about technical analysis is looking at candlesticks. So sometimes you will see charts of the stock market, even your apps, some of the graphics are lines that go like this, or lines that go like this. So other than line chart, there are candlestick charts that tell you a lot more about what's happening. There are different candlestick patterns that you can learn. And also, finally, there are what we call chart indicators. So some people have very fanciful charts that have many overlays. So these are indicators. right? So one can use technical analysis to determine what is a good price to enter, whether it is a buy first or a sell first, and when is a good price to exit, right? So that is how we can think of the entry and exit price. Next, like I mentioned, the sizing, right? So I mentioned that there are two things with sizing. Some people like to size according to value, saying that, oh, every trade must not be more than $5,000 or must be around $5,000 or $10,000. But some people will size it in a way that I'm always going for the certain number of shares, right? Uh, the reason why people have different preference in this is very simple, because those people who calculate their potential profit and loss based on the number of ticks, then maybe you will want to use volume, right? Because because let's say I buy 10,000 shares every time, the stocks that I choose tick by 1 cent every time, then I can tell myself every time, if I'm wrong, I lose 2 ticks, I always lose the same amount of money. Or every time I earn 5 ticks, I always earn the same amount of money, right? So that's how people would like to size it in terms of volume. In terms of value, some of them will say that I will take profit every time I get 5% return, something like that. And I will exit the trade cut loss if I lose 2%, something like that, right? So in this case, the sizing, whether to size by volume or size by value, really depends on individual preferences. And of course, sizing also depends on risk tolerance, right? Of the volatility, right? If a stock price swings like this, up and down very wildly, you don't want to have a big size for that, because every time it swings wildly against you, you might lose a lot of money. So for volatility, the greater the volatility, is suggested to have a smaller size. Also, the liquidity of the stock, meaning that the amount available on the buy and sell, if you are always looking at the queue and the queue doesn't, there's not much participation on the stock, then you might not want to buy that big a size, because if, let's say, the stock only always has 10,000 shares on the buy and sell queue, or 50,000 shares on the buy and sell queue, you don't want to be trading the shares in volumes of millions, right? Because how would I want to get out 1 million shares if every time I can only sell, let's say, 50,000 shares to the bid, right? So the liquidity affects our sizing as well, okay? So an example of a trade plan, this might look a bit complicated. Those of you who are familiar with programming might find it familiar. But with trading, we have to be very mechanical in order to keep our discipline. Okay, so one thing about doing trading is that we need very clear plans, very clear objectives, so that we are unwavered by emotional things like uh, maybe it will go up again tomorrow, or maybe it will come down cheap enough for me to buy, or maybe it will go up high enough for me to sell, or maybe it will go up a bit more so that I won't lose as much money. Emotional stuff like this, we need to put that aside. Our trading needs to be mechanical in order to be profitable. So this is an example of day trading, because time horizon is 1 day. So this trader has a particular kind of sizing that varies for uh, uh, different price of the stock. So every time it says that if it's less than 20 cent stocks, he takes 100,000. If it's a more than between 20 cents to $2 stock, he takes 20,000, and if it's a more than $2 stock, he takes 10,000 shares, right? So this trader has a very clear sizing and time frame, right? And then it says that you're looking for upside of 3 ticks, because this trader is going for short-term scalping, right? So and then clearly defines his break-even price, because when we buy and sell and we trade, we will definitely incur transaction fees, right? In the Singapore market, one not only incurs a broking charge, they incur exchange clearing fees. settlement fees and trading fee, SGX trading fee. So there are a few fees involved, and of course GST on top of everything. So whenever we trade, if we have a certain size, we always need to know where's our break-even price also. Because if we sell back at the same price, we will still incur the transaction fees, right? So the break-even is to cover the transaction fees. So the bottom part lists all the different situations where the trader will exit the trade. So like the first example, if I make more than 5 ticks, I get out, right? Or if I break even at some point of time where the stock price doesn't move and I break even, I get out. Or if the stock price goes down and I lose a bit, I get out. Something like that. So this is an example of how we can have an individual trade plan for individual trades, right? Like I mentioned, for the overall, we need the master plan to make sure that for every 3 trades or for every 10 trades, we always maintain profitable. And one thing to emphasize also that I've briefly mentioned is that when we are trading, we always have to review our performance after every maybe a fixed set of trades. So maybe in order to be fairer, we maybe don't review our own trading every 3 trades at a time. We review our trades every 10 trades at a time. So every 10 trades, the idea is to get a consistency that out of every 10 trades, I am profitable for at least maybe 5 or 6, right? Because if we are thinking in terms of I'm risking, let's say the previous example, I'm risking $200 to make $500, then if I'm making $500 all the time on 5 trades, I'll make 2005. If I lose $200 on 5 trades, I lose $1,000. Overall, I'm still profitable by $1,500, right? So we have to ensure, always review our trading to ensure that our overall trading is profitable. And the idea is you don't have to be right all the time, but we have to ensure that we are consistent, right? So with the example just now, even if I have only 5 out of 10 trades correct, that I'm only correct 50% of the time, which means I'm right or I'm wrong, right? I'm right or I'm wrong, so 50% or 50-50. As long as we keep to this kind of discipline, our overall trading will be profitable, right? So think of it this way. So that's it. This is the part I would like to emphasize for tonight. So once again, the idea is to keep it simple and keep to the discipline. The most important thing is to keep to the discipline. And like I mentioned before, you can keep to the discipline by always doing a review to see whether you keep to the discipline. If you're not reviewing your plans every 10 trades or so, you might want to review your plans weekly or monthly, right? Some people might say, oh, quarterly even, or even year, but yearly is a bit too long. So preferably maybe every 10 trades or every weekly or every monthly, because some people might say that, hey, I don't trade every day. So every week I might not even have 10 trades. So maybe try monthly basis. And of course, make sure that you're profitable, make sure your plans are maintained.